Good evening, students. I'm sure you all are geared up for the upcoming exams preparation, and you all have taken up all the portion for revision. By now, I'm sure you all would have completed a major part of revision of all the subjects, and you all are now on the track to achieve the final milestone of 5 years of hard work, right? So, students, let us start. First, let me take your questions, if any, from any previous topic, any topic in GST, customs, whatever we have done till now, while revising, while studying at your end. If you have come across anything which you did not understand, or you felt there was some confusion, something you could not recall, you can put it across. I'll take that first, and then we will go to your further syllabus. Yes, students, tell me. Anybody? Geeta, Swaminathan, who all are there? Anybody has any doubts?
No doubt, sir. Yeah.
Okay.
Good evening.
Very good evening, beta. Everything going good? Preparations
Yes, sir.
going strong?
Yes, sir. Going good.
Excellent. Okay, then let me take up the next part of our revision so that we should be able to complete the entire revision today. And then in the last two sessions, we'll take up some updates, some practical aspects. So now we are in a very important topic. This is a practical topic where we are supposed to determine the value for the purpose of computing the customs duty. Now understand one thing, the value on which the customs duty is to be computed is technically referred to as the assessable value. Now, this value is to be determined as per section 14 of the Customs Act, read with the custom valuation rules. Now see, since we are at the end of our entire syllabus, let us make a comparative study. If you try to connect this with the GST provisions of valuation, in GST we have section 15 of the CGST and the parallel SGST Act. Now, in section 15, first subsection 1 says the value will be transaction value. Same like here, section 14.1 also says value will be transaction value. But the difference is here compulsorily 14.1 requires you to go to valuation rules. Whether or not you satisfy the conditions of accepting transaction value, you have to go to valuation rules. This is not the case in case of GST. In GST valuation, 15.1 puts conditions. You satisfy those conditions, you remain in section 15 only. You go to 15.2 for additions, you go to 15.3 for subtractions, but you do not go to the valuations rules, I mean to say. This is how your customs valuation and GST valuation are different. Now, in custom valuation, same like GST, you have another value, which is the tariff value. In GST, it is section 15 bracket 5. In customs, it is 14 bracket 2. So what it says, where the value is also fixed by the government by way of a notification. In that case, you don't have to go to the valuation provisions. Your value will be the value determined by that particular notification, which is called as the tariff value. This part is similar with the GST law. Now, some technical terms which you should be aware of. One is the ex-factory price, the other is the FOB price, and the other is the CIF price. FOB price is also called as FOR price. What are these three values? Let us understand. So let us say I am the Russian supplier, you are the Indian importer. Now, when I'm manufacturing goods in my factory, which is in Russia, I have a price at my factory gate, from where First transportation is up to my port. Then the second leg of transportation is up to your port. And the third leg of transportation is from your port, that is Indian port, to your factory. Now, when I say X factory, it will include none of these transportations because X factory is the price at my factory gate. So even my transportation up to my port is not included in that. Neither cost of freight, that is transportation cost, nor the handling, nor the loading, nor the insurance. So nothing of transportation is covered when we are talking about X factory price. Generally, in international trade, this valuation is never used because if this valuation is to be done, then all further activities has to be taken care of by the buyer, which is practically at times impossible in case of international transport. So this is not done. Then we come to the second price, which is FOB, free on board, or it may be FOR, which is free on rail. This is where the foreign supplier brings the goods up to his port. So my port, let us say the Russian port, from where the goods would be loaded on the ship and dispatched to India. Now, when I say my price is FOB, it is up to my port. I have included all the transportation of the first leg up to my port. But what is not included is the transportation from my port to Indian port. That is what is FOB. If the goods are to be sent by rail, it will be FOR, that is free on rail. And then comes CIF, which is the price at which goods land at your port. Now, CIF, C stands for cost, I for insurance, F stands for freight, and it basically covers the cost, insurance, freight of transportation from the Russian port to the Indian port. That is what is CIF. Now, in all international transports and all international trade, the prices which are always quoted is FOB, and at times it is CIF. Now, default mode of valuation is equal to the transaction value that you are declaring plus whatever cost that have to be added. So what is the default mode? So the first priority, same like the GST toys, we also want to take your transaction value here as the taxable value with some additions which are provided in the rules. Now, how does the valuation section of the customs law provide for 14.1 is for transaction value, 14.2 is for tariff. You should always check whether CBIC has notified any value for your class of goods. And if it has done so, in that particular case, 14.2 will be overriding 14.1. So then you need not go to any other valuation aspect. You will do valuation strictly as per the tariff notification which is provided. Then you have the 14.1, which is the main valuation provision. Now, what is 14.1 saying? It says that we will take the transaction value as the taxable value with some additions. Now, what is transaction value? It simply means the price at which we have entered into this transaction of export from my side, import from your side. It is a price actually paid payable for the goods. Now, this part is important. And this part forms basis for all the further valuation provisions that we are going to study. Now, see, as a Russian supplier, seller, I have multiple markets. One is in my own Russian market, other is the Indian market, and third is other foreign countries, which may include European countries, which may include UAE countries, etc. Importantly, when we are talking about valuation, whether you take the tariff value, or you take the transaction value, or even later on, as we proceed, you take any of the values as per the valuation rules. What is important is for all these provisions, one common concept that will be flowing is that the value has to be the price, firstly, which is an international trade price, and secondly, it should be the price at which this foreign country or supplier is selling the goods to India. It is not my local price in Russia. It cannot also be my price to other countries. These prices are never taken in our value for obvious reasons. Because when I sell it in my own country, for me, the valuation, the costing, everything will be different as compared to when I export. Similarly, when I export to India and when I export to other countries, again, because of so many international trade agreements, so many treaties, whatever benefits I'm getting for export to India, I may not be getting to others. So again, my price for India cannot be comparable with my price to other countries. So this is the first important aspect that you need to keep in mind, that valuation in customs has to be value at your doorstep, that you'll come to know from the second point. And most important, it is the price which is the international price for export to India only. Now, second is the price should be such that it should be for delivery at the time and place of importation. So second point you have to keep in mind is price should be the price at your doorstep. Doorstep means at your place of importation, which is your port. So we take the CIF price indirectly. This is what this means. So you have to take the CIF price, which should include all costs till the goods land at the Indian port. These two conditions are common in case of GST also. Buyer seller are not related and price is the sole consideration. The definition of relation is also very much similar in GST and customs with few exceptional pointers. So this you need to keep in mind. Next, additional obligation of the importer where board has reasons to believe that the value of such goods may not be declared truthfully. Now, wherever the board, that is the CBIC, on the basis of past experience, believes that there is a possibility that the importer may be hiding some important information and may not be truthfully disclosing all the facts of the case. In that particular case, the board may provide for additional obligations, which we are going to see what are those additional obligations. Now coming to an important point. In the previous class, we discussed about rate of duty. What is the relevant date for deciding the rate of duty? It was, and also the tariff value, which we just saw in 14.2. So for both these things, deciding the rate of duty and deciding the tariff value, the provision says that you have to take the date of bill of entry or date of entry inwards granted to the ship, whichever is later. But this rule is only for rate of duty and the tariff value. Today we are seeing what is the relevant date for rate of exchange. Because all our international transactions would be in foreign currency, we need to find out its Indian equivalent so that we could determine the correct duty and taxes. What would be the rate of exchange for converting the foreign currency to Indian currency? In case of import, it is only one date and not whichever is later. If you see the provisions relating to relevant date for determining rate of duty and tariff value, there were multiple provisions. One, which said whichever is later. Two, for warehouse goods, it is the date of ex-bond bill of entry. Three, in any other case, it is the date of payment. Here, no such different dates are given. In all cases, the relevant date is only one date, date of filing the first bill of entry. In case of export goods, it is the date of filing the shipping bill. Again, the second point is, on this date, which exchange rate will you take? Now, why I'm saying which exchange rate you will take? Because you have one exchange rate, which is as per our share market. Second, you have another exchange rate, which is actually in the market by which the banks or the authorized money dealers, they make the exchange. And third, which we have to consider is the rate which is notified by the board. So you will ignore the share market rate, you will ignore the real market rate, you will take the exchange rate which is notified by the board for that particular period. Now, just a summary of what are the custom valuation rules. As I said, you have to compulsorily come to the custom valuation. What are these custom valuation rules? First, you take transaction value of your goods. Second, you take transaction value of identical. Third, you take transaction value of similar. And most importantly, you have to proceed in sequence only. So first, obviously, your transaction value, subject to the conditions that are given. If you satisfy, you need not proceed further. You can directly come to rule 10, which is the compulsory addition rule. But if you do not satisfy this, you have to go to rule 4, rule 5, That is not satisfied, you have to go to rule 7. Now, what is rule 6, which is not given? It says that you can interchange 7 and 8. So there you can first apply 8 instead of 7. This is what 6 says. Rule 7 is you derive the value by the deductive method. 8 says you derive the value by the computation or the cost sheet method. And 9 is the residual value. Now, rule 1, we all know it is short title commencement, not given here. Rule 2 again is similar, it is definitions. Important definition, we require the price at the place of importation. What is the place of importation? It is the custom station where the goods are brought for being cleared for home consumption or removed for deposit in warehouse. In short, it is the place where your goods are landing from where they would be cleared. Most important definition, related person. Now try to link it with the similar definition of GST law. There are many things which are similar. So first part, person shall be deemed to be related if such persons are officers, directors of one another business, they are partners, employer, employee. A third person controls directly, indirectly, more than or equal to 5% of the voting shares. So mainly it is equity shares. One of them controls another. A third person controls both of them. Such person together control a third person. Such persons are member of the same family. Up to this point, everything is same with one small difference. Here, what you have 5% in the GST law, that is 25%. This 1% difference is there. Here it is 5, in GST law it is 25. Barring this, all the first point up to here, persons are members of same family is same. What is different is this. This is not there in case of GST law. So this is what is the definition of related person comparatively between GST and the customs. Now, we start rule by rule. Rule 3 says you take your value only. That is, you take the value which you have and transacted with your foreign supplier. That is your transaction value. Their adjustments are to be made. Rule 10 gives you what has to be added, and Rule 12 gives you the obligation which we studied, that there could be further obligations that you have to satisfy. That is given in Rule 12. We'll see these two rules later on. Firstly, what does Rule 3.1 says? Transaction value will be the value after making additions of Rule 10. But it has put some conditions. What are these conditions? The transaction value will be accepted provided there is no restriction put by the seller on the buyer about how the buyer should use or dispose the goods. Second, whatever price I'm charging to you, that price should be capable of being computed. If I have put a price in such a fashion, putting such a condition for which valuation cannot be done, like I say that I'm selling goods to you, in return you have to take care of my family in India for next 10 years. Now for this, valuation cannot be done. So such value, if I have put, or such condition I have put, since valuation cannot be done, the value will be rejected. You have to go to other routes. Then either no further consideration should come to me. Whatever consideration we have fixed, only that should be there. Or if any further consideration will come to me, that should be computable today itself, for which Rule 10 has already provided an adjustment. But it should be such that it should be computable, determinable today. If I'm going to get some additional consideration in future and it cannot be computed today means at the time of import, then again our valuation fails. Buyer seller are not related, but then it goes a step ahead to say that we will still accept your transaction value where buyer seller is related if you as an importer are able to demonstrate means to justify, to prove that the relationship between you and me has not influenced the price. It means whatever price I'm charging to unrelated person, similar price I'm charging to you, you have to demonstrate this, justify this. Further, you should also be able to prove that even if our transaction value is not taken, what will happen? the law says go to other values. Rule 4, Rule 5, Rule 7, Rule 8. You should be able to again demonstrate that your price, that is our price, which is the transaction value of these imported goods, is very closely linked to the value which you are going to determine in other rules. So even if our value is rejected and other rules are adopted, the valuation would be more or less similar. So when, as an importer, you prove these two things, then even though we are related, our value will be accepted. And you can understand logically why. Because if our relationship has not affected price, no reason of rejecting it. Second, even if you reject, you go to other values will be coming to similar with some 5-10% variation. So why to go to other value? That is why you should be able to demonstrate this in case we are related. Then again, our price, our transaction value will be accepted. Then comes rule 4. Now, rule 4 says if our price is not acceptable because of breach of any of the above condition, we start using the valuation provisions. And what does valuation provision says? The first provision says you take the transaction value of identical goods. Now, what are identical goods? Identical goods means the same goods which I have sold to you. The only difference is I have sold to somebody else at or about the same time when I have sold the goods to you in the same quantity at the same commercial level. So, in short, when you imported goods from me, the same goods I have even sold to some other importer in India because I'm a businessman. I have many customers in India. So, what I'm selling to you, I'm also selling to other importers. So, identical goods means copy paste same goods. Maximum thing what they are allowing is some minor variation, which is not affecting the price. So what could be minor variation? You have specifically asked me to put a particular type of wrapper, but your other importer has asked me to put another, and the third importer has asked me to put further other type of packing so that at least you all three can differentiate your goods, but that packing does not affect the value. So for such minor differences, barring that, what I am selling to you, the same thing, the same supplier or the supplier from the same country is selling to some other importer. That is what is identical. Now, since the goods are identical, same to same goods, and if our transaction value is rejected, rule 4 says take transaction value of any of these other identical goods transaction with condition that these identical goods should be imported at or about the same time when your goods are being imported at same commercial and same quantity level. And in case same quantity or commercial level is not available, fine, we will make adjustment for that. Next, either it should be by the same mode of transport, the distance should be same. And in case that is not same, let us say my supply to you is by sea and the other importer is by air. So definitely the freight cost, the handling cost would be different. So that we will adjust. Most important, in case more than one transaction value of identical goods are available, lowest will be taken. So you wanted one, but at the same time, as I said, I have supplied to multiple importers at the same time in the same quantity. Then what way can be done? All other importers' price, take the lowest. This is how valuation is done by the rule 4. What is rule 5? If let us say identical goods are not available. Why? Because what I'm supplying to you, I'm not supplying to anybody else. Then they say you take transaction value of similar goods. Now, what are similar goods? Similar goods means where similar types of goods are supplied. Similar means where the goods are not exactly same. So your goods, what is supplied to you, and goods what your other importer is importing in India is not same, but they have the same functionality. They are used for the same purpose and they bear the same brand. So for example, you are importing lead pencil, which is of Natraj, and the other person is importing lead pencil, which is of, let us say, Classmate. So both are lead pencils, both are of same type. The only difference is one is made by Natraj, one is made by Classmate. There is not much difference. Maybe look wise they would be different because obviously different brand companies will have different structure, but functionality wise, usage wise, they are same. And a very important word is used, they are commercially interchangeable. What is commercially interchangeable? If let us say a student goes to a shop and he asks for a Natraj pencil and the shopkeeper says, sorry, Natraj pencil is over. So when he shows a classmate pencil, the student is ready to buy because for him, what Natraj pencil does is also what Camlin pencil will do or classmate pencil will do. That is where we say they are commercially interchangeable. Such goods are called as similar. Now, if identical goods are not available, you try to find out transaction of similar goods again with the same condition which we studied above. At the same time, same quantity, same commercial level, same mode of transport. If there is variation in any of these, we will take that with adjustment for the variation. Next, what does rule 6 says? After you have tried 3, 4, 5 and you did not get the value, now actually next turn is of 7. However, rule 6 says you can interchange the application of 7 and 8. Now 7 is deductive method. Now, when all the above method fails, your transactional is rejected because some condition is not satisfied. Identical not available, similar not available. Then what to do? This is no problem. Come back to my case. So what I have exported to you, you have imported. Now what you are doing after import, see that. If after import, what you are going to do is whatever I have sold to you, without making any major changes in that, either you'll not make any change or you'll make some minor finishing changes and you sell the goods in India. Now what rule 7 says, take the Indian price at which the importer is selling in India. But that price is not acceptable because we want the price of import. We want the international price. This is a domestic price. But they say, wait, what an importer would have done after importing, he would have added his expenses plus added his profit margin. That would have become his selling price at which goods he is selling in India. Now what we are doing is we are going reverse. So you take the selling price of these goods in India to an unrelated buyer in India, take that selling price and deduct both these things, the profit margin and the cost which would have been added. What you will get is mathematically the import value. This is what is deductive method. So under this method, we have to go backward. So we take the unit price, that is per unit price at which this imported goods, etc., are sold in greatest aggregate quantity to unrelated persons in India. So after import, when these goods are sold in India without any major alterations, then that sale price is the starting point, and then you will deduct all these things from that price. Is this clear? Now somebody will ask me what is greatest aggregate quantity. So there is a possibility that after import, I'm selling the goods to someone in 1,000 quantity, someone for in 100 quantity, someone in 500 quantity. So out of these, which one you will take? You will take the price at which the greatest quantity is sold. You will take the per unit price of that, and that will become the basis for valuation. What is computed value? Now, computed value is, I call it as the cost sheet approach. So now in deductive, we took the Indian price and we came backward to determine the import price. In rule 8, we go to the origin, we go to the supplier's details, we try to get the supplier's details, and from the supplier's detail, we do costing. So how supplier would have done costing? He would have prepared cost sheet, taken the raw material consumed, the direct wages, direct expenses, production, administration, selling overheads, profit margin. And this is how he would have determined the base price, X factory price. And to that, he would have added all the cost of transport till the goods reach in India. All this will become your value as per rule 8. So you simply do cost sheet by adding up all the cost, adding the profit margin, and adding all the expenses for all transportation and everything till the goods land in India. This is what is the computed value approach. Now, what is the method given for application of these rules? First, valuation rules are to be applied sequentially. As I already mentioned, you have to go sequence. Rule 3, that is our value. Rule 4, identical, similar. Rule 7, deductive. Rule 8, computed, but you can reverse deductive and computed. However, importer may request officer to apply computed value before deductive because this is what even rule 6 says. Now, in case none of these rules help, then we have no other option but to follow the residuary method. So by residuary method, you find the value. Now, technically, residuary method has not given any method of computation. It has only given you a guidance saying that you will determine the value using reasonable means, which is consistent with the provisions what we studied till now. So you apply what is given in section 14, you apply what is given in other rules, and taking a overall logic from that, try to determine the general principles of valuation, and using those principles you determine the value. Now, most important, since this is slightly judgmental, there is no predefined structure, there is a possibility that people may come up with vague values. So for this purpose, some conditions, restrictions are given. So what is the restriction? Residuary value shall not, this is very important, residuary method shall not be used for valuation on this basis. It means you will not use any of these when you are using your residuary approach. So in residuary, this cannot happen, what is given below. So what cannot happen? You cannot take the selling price in India of the goods produced in India. See, we want international transaction, you want international price. So you cannot take Indian price of Indian goods. Second, the residuary method should not be such that where the system will provide you to take highest of the alternative values. So if you are having alternative values, the residuary method should not ask you to take the highest of the value. Next, again under this method, you will not take the price of goods when they are sold in India, because we do not want domestic market price, we want the international price. Then the cost of production other than computed value should not be taken. So if you are going by the costing approach, it has to be strictly as per our rule 8. Then price of goods for export to any other country. So as I said at the start, we only want price between you and me. That is the price at which I am selling to India. I may be selling to other countries, not allowed. I may be selling in my own country, not allowed, right? Next, it should not provide the method which will take lowest of the prices. So neither it should allow for taking highest of the price, neither it should ask you to take lowest of the price. So under residuary, you cannot go by any of these methods. And finally, it should not take any arbitrary or fictitious value. So in short, these are some restrictions posed when you are using this residuary approach, that you cannot do any of this while following the residuary approach. This is what it simply means. Now coming to a very important part in valuation, where they say that you have to compulsorily add some expenses while doing valuation. This is compulsory. So irrespective of which method you are following, whether transactionally of imported goods or of identical similar goods, this has to be done compulsorily. Now, what is compulsorily to be added? That is what is given in Rule 10.1. Commission except buying commission. Now, what is buying commission that we need to understand? So, buying commission does not mean the commission which you are paying to the foreign agent. In fact, that commission is to be included. Then you will say, sir, then what is this buying commission which is excluded, which should not be added? The answer is, it may happen that you have appointed a person outside India who is only going to help you select a supplier. That's it. Once you have selected the supplier, his role is over. Now, whatever orders you are placing on that supplier, he is not getting any commission. Such a commission or such a charges which you have paid to that person, only helping you to select a buyer, is a buying commission, which is not included. But where you are supposed to pay commission to such an agent on the basis of every import. So whatever import you are doing, whatever quantity value of import you are doing, some percentage commission you are giving to that particular foreign agent, that is includable. Next, what is to be added? Cost of containers packings. What is to be added? Engineering design work undertaken elsewhere than in India. So if the foreign supplier, let us say this Russian supplier, has got your goods engineering done from Japan or from Germany and has incurred some cost, that has to be included. Then next, materials, tools, dyes consumed used in the production of imported goods supplied free of charge. So if importer, that is you, have yourself sent me some raw material, some components, and you have asked me to use this in this particular final product, obviously you would have given to me all these things free of cost to be included, to be added in your product. That will not be included in Rule 10. I'm sorry, that will be included in Rule 10. Now, how it will be included? It will be included by apportioning. What is this apportion? So let us say you have given me some dye, which I have to use while making your product. And this one dye can make 1 crore pieces. Now, today I am supplying you 10 lakh pieces only. So whatever is the cost of your dye, that divided by 1 crore multiplied by 10 lakhs. This is what is the proportionate value which has to be added in this valuation as per Rule 10. Next, royalty license fees, which is part of the sale. Proceeds of any subsequent sale. See, this was one of the condition also in Rule 3. If in future you are going to give me some portion of your earnings, so what we have decided is today you'll give me lump sum, let us say 10 crores, plus in future when you will sell my goods, whatever you will earn, you will further pass me 5%. So you are going to give me some proceeds out of subsequent sale also. In that particular case, the rule says we should include that further or future proceeds which I am expected to get, because that is also part of my consideration. So that should also be added. And further any other payments which are condition of the sale. Now, what does Rule 10.2 says? See, Section 14 said that we want the value at the time and place of importation. Now, in order that we get such a value, we have to ensure that all costs which are incurred for transporting the goods up to the port of importation, plus the loading, unloading charges, handling charges, all up to the port of importation. Port of importation is the Indian port. That should be included, plus whatever is the insurance, we call it as a transit insurance, that has to be included. Now, when you want to include this, the transport cost, the insurance cost, there are some provisions given to this. If this transport cost is not ascertainable, so let us say in the sum, the freight is not given. So you are given the FOB price. FOB price is the value at my port, but we want the value at your port. Now in this particular case.
हेलो
Yes.
सर, ये जो लोडिंग अनलोडिंग चार्जेस है, ये एक्सपोर्ट का जो पोर्ट रहेगा वहां का ऐड करना है या फिर यहाँ का इंडिया का भी ऐड करना है?
एवरीथिंग ऑफ इंडिया। सी, एक चीज समझिए, एक्सपोर्ट के पोर्ट के तो चार्जेस बाय डिफॉल्ट आएंगे, हमें इंडियन पोर्ट तक जो भी इनकर हुआ है तो ऑब्वियसली एक्सपोर्ट का तो आना ही है ना, क्योंकि पहले मेरे यहाँ पे लोडिंग अनलोडिंग हुआ रहेंगे चार्जेस, फिर आपके यहाँ पे होंगे। करेक्ट?
तो सर 2 बार हो जाएंगे फिर तो, एक बार वहां पे एक बार यहाँ पे।
एग्जैक्टली, तो बेटा 2 बार इनकर भी तो हुए हैं ना, मेरे यहाँ से लोड करने के हुए, आपके यहाँ पे अनलोड करने के हुए, तो जब दोनों जगह पे इनकर हुए तो दोनों आने भी तो चाहिए ना।
और सर एक बाइंग कमीशन का जो आपने एग्जांपल दिया था, एक और एग्जांपल दीजिए हो समझने के लिए।
बाइंग कमीशन में एक ही चीज है जो नहीं आती है, दैट इज आपने फॉरेन कंट्री में एक ऐसा एजेंट या ऐसा पर्सन रखा है जिसका काम सिर्फ आपको सप्लायर ढूंढ के देना है। एक बार उसने सप्लायर ढूंढ के दे दिया, उसके बाद आप कितना उससे इंपोर्ट कर रहे हो, आपका पर इंपोर्ट कोई कमीशन नहीं है। इस कमीशन को हम इंक्लूड नहीं करेंगे, इसको इन्होंने बाइंग कमीशन बोला है।
ओके
फाइन बेटा, ओके great. Now we were discussing what if freight cost is not given. In that case, you will take the freight cost on a deeming basis, which is 20% of the FOB value. Now importantly, where freight cost of air transport is given, I repeat, air transport है, उसका freight cost अगर दिया भी है, in that case also you have to apply this 20%. So what is the rule? If the transport is by any other method except air, then the rule is you will take the actual freight if given. If not given, you will take 20% of FOB. But if the transport is by air, in that particular case, the rule is 20% is the maximum that you can take. 20% is the highest that you can take. Means in case of air transport, where actual freight is given. Now for other transport, what you do where actual freight is given, you directly take that actual freight, that's it. But where it is air transport, and if actual freight is given, you will not take the actual freight. You will compare it with 20%, you will take whichever is less, because in air transport, 20% is the maximum limit. In other transport, there is no maximum limit. Whatever is given, you will take. In other transport, only if nothing is given, then you take 20%. So I hope you're understanding this difference. Now, if customs FOB not ascertainable, but customs FOB plus insurance cost ascertainable, in that particular case, the transport cost is 20% of FOB plus insurance. So general rule is above we read, you have to take 20% only of FOB. But if let us say only FOB is not ascertainable, it is FOB plus insurance which is ascertainable. In that particular case, you will take FOB plus insurance and take 20% of that. Now, similar rule, if insurance cost is not ascertainable, if it is not ascertainable, the first rule is you will take 1.125% if it is not ascertainable, and 1.125% of FOB. And let us say again, if only FOB is not ascertainable, what is ascertainable is FOB plus freight, then you will take FOB plus freight and take 1.125% of that amount. This is that air transport point, that air transport cannot exceed 20% of FOB. Correct? In case goods are imported by sea or air and transshipped to other customs stations in India, the cost, insurance, transport, loading, unloading, handling associated with such transshipment shall be excluded. Why? Because it is being done within India, and we only want the first port of importation costs, not for further transportation within India. Next, cost of transport of imported goods includes, now this is important, if there is some ship demurrage charges which are incurred on chartered vessels, that will be included. Similarly, the litterage or bar charges, if any of these are incurred on the chartered vessel, they have to be included. So this is how valuation is done. You take FOB, you do adjustments given in rule 10, you get the CIF value, which is the value as per the customs. Now we come to rule 11, which says declaration by the importer. Now this is the additional obligation. What it says, the importer or his agent shall give a declaration disclosing full and accurate details regarding the value. So whatever details are required for determining the value, you have to give all details full and correct, and you have to give a declaration that this is given full and correct and nothing is kept back. Most important, despite of you doing this, giving the full details, still the proper officer has the power to reject the value declared by the importer. So despite of you giving all details, the proper officer has the powers when, if he has reasons to doubt the truth or accuracy of such value, and most important, it shall be deemed that the transaction value of such imported goods cannot be determined under 3.1. It means you'll have to go to rule 4, 5, etc. So where the officer rejects your value on the doubt regarding its truth accuracy, the valuation will be done as per the other valuation rules. Now all this was about import valuation. The next is export valuation. Now once you have understood import valuation, export valuation is very much similar to import valuation provisions. First, what it says, goods of like kind and value. So it has determined, like we had the term similar goods, we had the term identical goods. Here there is a different term used, which is goods of like kind and quality. Then what it says, value for export is the transaction value subject to rule 8. Again, what is rule 8? The same power of the officer to reject your value. What are the conditions? Buyer, seller, if they are related, then also transaction value will be accepted. When same condition like import, you have to prove that relationship has not affected the price. If value cannot be determined under rule 3, the value shall be determined by proceeding sequentially to the other rules. What are the other rules? First, if your transaction value is rejected, you will take the value of goods of like kind and quality. So how we had the concept of identical, similar in case of import. Parallelly for export, we have other term which is goods of like kind or quality. So you will take the transactional value of such goods. If that fails, you go by the computed method, and last is the residual method. So you'll find that same or similar type of methods which were there in case of import are there. What is not same, which was there in import valuation but not in export valuation, is you do not have deductive value method over here. Next, same declaration by exporter and the power of the proper officer to reject. So these are the valuation rules. This section 15, relevant date for determination of rate. I was mentioning this at the start. So this we studied even in the previous chapter. So what is the relevant date for determining the tariff value and the rate of duty? In case of imported goods, it is where the goods are entered for home consumption. It is later of these two dates, bill of entry, entry inwards date. In case of warehouse goods, it is the export bill of entry. And in case of other goods, it is the date of payment. What is the relevant date for determining the rate and value for export? When they are entered for export, it is the date of let export order. And in all other cases, it is the date of payment of duty. Yes, beta. Somebody saying something? Yes, is somebody saying something?
No, sir.
Okay, I just heard some sound. I thought somebody is asking some doubt.
Yes, yes, sir. Some sound, but no questions on there.
Okay, no problem. Fine. I think somebody's mic is on. No. Okay. Now we have this section 19. Again, students, try to understand. If I try to draw an analogy, in our GST law, we have the concept of composite supply, mixed supply, right? Similar to that is section 19. Now, what was composite supply, mixed supply in case of GST, where more than one items are supplied together? Now, over there, it can be goods and service also. Here, definitely there will be no service because we are talking about customs. But the important point is, just a second, students. Yes, student, sorry. So now we were discussing this, that like how your GST law has this concept where two or more things are supplied together. Then in section 8 of the GST law, we are given the provisions which says that you apply the concept of composite supply, mixed supply, and then accordingly you determine what should be the treatment. Here we have section 19, which says that where you are importing a set of articles. Again, what is set? Set means 2-3 more things are combined in one thing. So 2-3 things are made one combo pack, made a set of articles. If you import any such thing, then how to do the valuation? So what is the first possibility given? The first possibility is that in this set, that is in this combo, there are different articles which are liable to duty with reference to quantity. So whatever different articles are there, for all the articles in that set, the customs tariff has given the rate of duty per unit per kg, that is depending upon the physical attribute. In short, valuation is not required. Then you can easily calculate the duty on the basis of the physical attribute, because that is what is already available, that is the quantity and all. But where the articles are liable to duty on the basis of value, then what you will do? First possibility, the different articles in this set, in this combo pack, are liable to same rate. Again, no problem. You have the combo pack price, you take that price, multiply by that single rate. But where they are liable to different rates, it is saying you take the highest of the rate. So if you try to compare it with our GST law, they are trying means they have made a provision which I will try to compare with GST law and says it is like the composite or mix. It is the mixed supply concept. So how in case of mixed supply, we take the highest of the rate. Similarly, 19 says where there are different rates, you take the highest of the rates. Now, importantly, same like the mixed supply, if one of your article in this set, in this combo package is not liable to duty, there is some exemption or the rate is zero, still what will happen, because of the above provision that you have to take the highest of the rate, indirectly this will also get taxed where you are falling in the above provision, that is you have to take highest of the rate. So now what is the option given to you? The option or the possibilities, if you want to save this additional burden, you have to provide the split of that value which is of the set, and you should be able to justify the individual value of those articles. If you are able to do that, we will charge the duty applicable to individual article. If not, we will go by this section 19. Now, many times it so happens that accessories or parts are imported along with the main item. So you are purchasing the machinery, and along with the machinery, the required tools, the required spare parts are also supplied. And obviously that is also charged by the supplier. It is never given free of cost. So like let us say you have ordered some cutting machine. So along with that, the blades are also supplied. The nuts and bolts are also supplied, for which they are charging. In such a case, they are saying that this is also an example of a set, because you have machine plus you have the blades, the different nuts and bolts. But here, if it is accessories and parts, then we will charge it at the rate which is applicable to the machine, that is the main article, provided they are compulsorily required to be supplied along with that article, and no separate charge is made for the supply and their price being included in the price of the relevant article. So means what? These blades and all, these spare parts are to be supplied compulsorily along with your goods. If that is the scenario, then we will include it and we will tax it at the rate of goods. Then we will not apply the highest rate method. Fine, students. So this is about valuation. I'll go to the chat box. There are a few questions. Okay. Sir, in section 15, letter of bill of entry, filing entry of vessel. But say when we file bill of entry, duty need to be paid. Why, beta? See, bill of entry, when we file, we have to only do assessment. Duty is paid only when the goods are finally removed. So at the time of filing bill of entry, we have to only do assessment, not make payment, right? Because when someone filing bill of entry, it means he's paying custom duty. No. So at the time of filing bill of entry, there is no payment. At the time of filing bill of entry, there is only assessment. Payment is when you are taking the goods out of the custom charge. That is when you have to first make the payment. So this problem which you are envisaging is, I believe, will not arise. Fine, beta? Is this clear? Perfect. So let us go to another chapter. Now the next topic that we'll cover today is the import-export procedures. Now in this import-export procedures, this is more of a theoretical, or you can say the procedural part, where we are going to study how import is to be done, what are the different timelines, what are the documents, etc., etc. This is what is covered in this particular chapter. So let us check this, what is given. So first, they have defined conveyance. Now, conveyance simply is the mode of transport. So if it is sea, it would be vessel, aircraft for air, and by road, it is vehicle. Now, exporter, exporter, and importer, these two definitions are very interesting in customs. So the definition of exporter, importer covers the owner also, the beneficial owner also, and most important, that person who is holding himself out to be exporter, holding himself out to be importer. Now, what is this? Now, please understand, sorry, many times it so happens that, like for example, I have ordered some goods, I want to import some goods which are coming from UK, US. But I will not go to the Bombay port, the Gujarat port for actually clearing these goods. I will not go there. Please understand this. Means what? Means I will appoint a CHA agent, custom house agent, who will be running this whole procedure on my behalf. I may not even be knowing a single procedure. I never go there. So it many times happens practically in case of your customs that your goods are not cleared by you. It is cleared by this custom house agent first. Secondly, many times it so happens that the actual importer never turns up, or if you remember what we did in the previous class, those two, three chapters, in that one of the chapter was that it may happen that you forgo the goods, you abandon the goods. Now you have abandoned the goods as an importer, so customs will sell it to anybody else. So whoever claims that, okay, I want to buy these goods, that is whoever want to get himself treated as an importer exporter, the law has made a provision to even include them as importer exporter. Next, foreign going vessel, foreign going aircraft. Now what is this? See, firstly, what is the purpose of this? The purpose of this is to exercise control. Control over those vessels or aircraft which are going out of India. That is why this concept is coined. Now, what it means? It means any vessel or aircraft which is engaged in carrying goods passenger between ports in India and outside India. In short, who are engaged in international transport. So firstly, we are concerned with only those ships and vehicles which are carrying goods and passengers. So if any ship vessel is not carrying goods passenger, we are least bothered. This is the first part. Second, it also covers those vessels which are naval vessels of a foreign government and which have come to India because we are having joint naval exercises in our Indian waters or just outside the Indian waters. So many times you will hear this on news that we, along with Australia or maybe US or maybe with Japan, we are having some joint naval exercises. Now it may happen in either our seas or their seas. So even the naval vessels of a foreign country are covered in this definition of foreign good. Next, any vessel engaged in fishing and other operations outside territorial waters of India, these are generally the ships or vessels of other country. So when other country fishermen are fishing somewhere near to our territorial waters, obviously if they enter, then we can always take legal action. But if they are just nearing our territorial waters, we need to keep a watch just to ensure that it is not any illegal immigration attempt, it is not any terrorist attempt. So for that, again, they are also kept in this particular provision. And then finally, any vessel aircraft proceeding to a place outside India for any purpose. So any vessel which is going outside India for any purpose. Now this any purpose word is very important. And even any vessel means now it may or may not carry passengers and goods. So it may happen that some plane is hijacked and it is being taken outside India. Now it is very important that as a responsible government, if we get to know from any country that there is some hijack attempt happening, even though the plane is going outside India, still we should exercise some type of control on that so that we can, if possible, foil this hijack attempt. So that is why even such last category is included in this definition. Now, all the formalities which we are going to see in the further provisions, all the responsibilities have been cast upon this person called as person in charge. So this definition is again important. Now, who is person in charge? In very simple words, it is that person who is having the control over that conveyance. Who decides where the conveyance stops? Who decides where the conveyance will, which route the conveyance will take? Such a person who is having such a control over the conveyance is the person in charge. Now, for a vessel, it is the master of the ship. For aircraft, it is the commander or pilot in charge. For the railway train, it is the conductor or guard. And in case of any other conveyance like truck and all, it is generally the driver itself. So these are the person in charge, and you will see in the latter part of this chapter that many responsibilities, obligations, compliances have been put on this person. Now, entry means what? Interestingly, entry and entry inwards are two different terms. Now, many times we feel that entry word, which physically means coming inside, applies over here. Answer is it does not apply over here. Entry over here does not means physically coming inside. Then what is entry? Entry over here means making a note, noting. Like we say, I pass this journal entry. Now, when we say you are passing a journal entry, means what? You are noting that point. So here also, what is entry? Entry, they say, in relation to goods means an entry, that is a noting made in the bill of entry. This will happen in case of import, or shipping bill of export in case of export, and it will include entry made as per the regulations under 84 with respect to post or courier. So when any goods are to be brought into India or taken outside India, you file the bill of entry and you mention the details of the goods in the bill of entry or the shipping bill, as the case may be. This mentioning of the details of the goods is what is the meaning of the word entry. Now we start with the procedural part. Now here comes firstly, what is the obligation which is put on this person in charge? Now this person in charge is the most important person because he is having the complete control over that vessel, over that aircraft. This person has been casted with some important responsibilities. First responsibility is that whenever this person is entering India, it should only come to the ports which are appointed as custom ports, custom airport. It should not go to any other place. If it is going to any other place, it may tantamount to smuggling or an attempt to enter into India through illegal routes. So whenever it is entering into India for the very first time and it is carrying passenger cargo, it should report, I'll use this word, it should report only at a custom nominated port airport. However, there is an exception given, which is a very logical and a practical exception. What it is, that it may happen that there is some distress situation, some accident has happened, or there is some weather related distress, or there is some technical problem in the engine or in any part of the aircraft, and it has to make an emergency landing. And the situation is so grave that it is not possible for it to even report to the nearest custom port airport. It may have to even land at some non-port airport area. In such a case, it is allowed to do this. But when it is landing at a non-custom port airport place, then some additional responsibilities have been cast. What is this additional responsibility? Okay, chalo, we agree to this, that because of some emergency situations, we landed at a place which is not a custom nominated port airport, fine. But then after landing, what you are supposed to do is, you are supposed to inform about your landing, about your arrival to the nearest custom station, if not to the nearest police station. And over there, you have to submit them your records, especially the logbook. So logbook is the details of from where the ship is coming or the plane is coming from where, what all routes it has taken, what all places it has landed. So all these things are in the log. So you have to produce this. Then without the consent of the officer, you should not allow the passengers or the goods to be unloaded. Again, this has an exception. If there is a situation where the plane is going to be blasted or any such thing, that is to ensure safety, obviously you'll allow them to leave the plane. Otherwise, before the arrival of the officer, that is the custom officer, police officer to whom you have reported, the goods and the passengers should not be allowed to leave the vicinity of that vessel or aircraft. And then after the officer arrive, whatever other instruction the officer give, you have to comply. So the first obligation, the first procedural requirement is, after coming to India, that is for the first time when you come to India, you should compulsorily come at the custom nominated port airport. Rule 29. Now, Rule 30. Once you are coming to India, the second most important requirement is you have to give this very important document. Now, this document is called as the arrival manifest or import manifest, import report, arrival report, etc. This you have to give to the custom officer. Now, what is this arrival manifest, arrival report, etc.? So it is the details of what you are carrying in your ship or aircraft, from which places the passengers or the goods have been loaded in your ship or aircraft. These details are mentioned in this particular report. Now, this is very important because only on the basis of this report, the customs will allow you a very important permission, which will come in the next point, that is permission of entry inwards. And without that permission, you cannot unload the goods. Now, when you give this report, which contains the details of what goods you are carrying from, where you have loaded the goods or the passengers, etc., then the customs will use this report to check: one, are you carrying any prohibited goods? Two, are you coming from such a place for the time being where the government has some restrictions, challenges, so that accordingly the custom officer may give you any further instructions, or it may even not allow you to enter, depending upon what you are carrying and from where you are coming. That is why this report is very important. Now, what is important that you need to keep in mind and prepare is that what are the timelines. So when you are coming by vessel or aircraft, this report has to be given before arrival. So obviously through online mechanism, you have to file this. And when you are coming by, let us say, truck, that is from any vehicle, in that case, you can give it online if possible, that is before arrival, or generally where this is not possible, then after arrival within 12 hours, you have to submit this report. Next, penalty for delay is 50,000. And after submitting the report, if you feel that some data is left out, some names have to be changed, some goods details have to be changed, you are allowed to amend or add the details, provided the officer is satisfied this was not done intentionally with the intention to evade tax. It was a mistake. Sorry. Now, similar to this arrival manifest, which contains details of goods, you have to give another similar report which contains details of the passengers and the crew members. Same point. Similar to the above point, that is for goods, this is for passengers and crew members. Next, as I mentioned, once you submit this report, on the basis of this report, the customs will give you the permission of entry inwards, which is the permission to allow your ship to bank at the port and also to unload the goods and passengers. So what does now section 31 says, that again it is another responsibility on person in charge, that before this permission of entry inwards is given, you should not unload any goods and you should not allow the disembarking of any of your passengers. Again, exceptions are that unloading of baggage accompanying passengers, members of crew is allowed. Mail bags can be unloaded, animals, and even perishable or hazardous goods. These can be unloaded. Other than this, other things cannot be unloaded. Next, imported goods not to be unloaded unless mentioned in this report. Now, very important thing. First, unloading can be done only when you get the permission, which is the entry inwards permission. Second, when you give this report, this report also contains the details of what goods will be unloaded at which port, because you may be going to multiple ports. So if you are coming to Indian port, in your report, this import report or report manifest, the details as to what goods are to be unloaded at which port is also mentioned. So what is this section 32 obligation? That the person in charge should not allow unloading of goods to any port other than the port for which the goods are mentioned in the report. Next, loading unloading to happen only from approved places. So within the port also, port is a very big area. So they want that unloading and loading unloading should be under proper custom supervision. So in fact, the next section is that only, that this loading unloading should happen in the proper supervision of custom officer, and hence the previous said that it should also happen only at the approved port. See, all these things are done to avoid any type of smuggling attempts, any type of attempts of illegally bringing into India something. So that is why these conditions are there. Next is a very interesting point called as boat note regulations. Now, boat note regulations are a separate set of regulations which are applicable whenever the goods have to be carried in water. Now, what is goods are being carried in water, which is called as waterborne. Now, this particular provision applies whenever, let us say, your goods which has come in huge vessel, the vessel is of huge size. Now, the port is such that near the, port, the depth of the water is not much. The water is very shallow, or at times you'll find that in some ports, there is a lot of mud, there are grasses, so plants. This may hamper the ship's lower part. These things may get stuck up, the ship may get stuck up in that mud or in the plant. Now, to avoid this, the huge vessels will never come near to the port where the port is having any such type of conditions, features. In such case, what these ships do, they stay away from the port, maybe 8, 10, 20 nautical miles away, so much away that they are not even visible from the port. And over there, they will inform the port that we want to unload these goods. So the port will send small boats, and these goods are now brought to the port through these small boats. At times, it may also happen that where the boat has come to the port, but it cannot come exactly to the barge or to the place from where landing can happen or unloading can happen. So what happens? The water is very shallow. It is your waist height or it is your chest height. So in such cases, people go inside the water walking and they carry the goods on their head. So many times even such type of unloading is done. So all this is what is goods being waterborne. Now, whenever goods are to be carried in different smaller boats than what compared to the ship in which they have come, then there is this additional leg. And there is a possibility that when goods are unloaded in the small boats and these small boats will come to India, there is a possibility that they may get deviated to some other place, which may be also a way of smuggling. To avoid this, Section 35 says that wherever the goods have to be carried in these smaller boats or carried through water, you need to first take permission from the customs for allowing you to do this. And for this, you have those boat note regulations. And only as per the custom instructions, you will do this particular activity. Otherwise, you will not do. Now coming to the detailed import procedure. So first, the person in charge will call at a custom nominated port airport. It will deliver the import manifest. On the basis of import manifest, it will be granted the permission of entry inwards. The goods would be now unloaded, one at the approved place, two under custom supervision. Then once they are unloaded, they are given not to the importer directly. They go into the custody of an authority, which is generally the Port Trust Authority, which is over here called as custodian. So the goods, after being unloaded, are not given to the importer. They go in the custody of the custodian, which is the port authority. Now, as an importer, you want to clear these goods. You want to take the goods, for which purpose you have to follow the procedure of filing the bill of entry. So what you do is you will file the bill of entry as an importer, and this bill of entry will be filed as per the provisions of filing bill of entry given in section 46. Now, there could be different types of bill of entries. First, for getting the goods cleared here itself, which is for home consumption, or for shifting it in warehouse. We are going to see the warehousing chapter after this. Or for further transporting it either even outside India or within India, which is called as transshipment. Now, if you want to clear it immediately, you have to even assess the duty, and before clearance, not at the time of filing bill of entry, but before clearance, you have to pay the duty. So you file bill of entry, do assessment, and before clearance, you pay the duty and take the goods. If it is for warehousing, you need not pay any duty, but you have to give the bond equal to 3 times the duty which is assessed, and then you follow the warehousing procedure. Then after that, whenever you want to remove from warehouse, you have to again file a bill of entry, which will again be bill of entry for home consumption. It is also called as ex-bond bill of entry, because now this bill of entry is for removing from warehouse. Again, make payment and take the goods from the warehouse. So this is how the entire procedure happens. Now, what happens in case of export? In case of export, the exporter files the shipping bill, which is at times filed electronically, or he may file bill of export. Shipping bill is for aircraft and vessel, and bill of export is for transport or export by road. Now, this shipping bill is then given or sent to the proper officer. Proper officer will do his assessment. Then after making the assessment, if any duty is payable, it will inform and you have to pay the duty. If the officer is satisfied that the goods entered for export are not prohibited and exporter has paid duty wherever applicable, then only he will pass the order permitting clearance and loading of goods for exportation. Otherwise, he will reject. Second, after all this is done, the goods are loaded on the conveyance for export with the permission of person in charge. Second possibility is that whenever goods are brought in for this importation, the proper officer will be giving a proper order, which is a written order, and only on the basis of this written order, the conveyance is allowed to leave the customs port and take the goods out of India. Now, coming to this next point, which is also called as the baggage rules. Okay, before that, there is some question. Sir, after depositing in warehouse, clearing the goods from warehouse, what rate applicable? See, when you are saying rate, we just studied in the previous chapter and we even studied this in the previous class also, that section 15 says that the rate of duty as applicable on the date of second bill of entry, which is called as the ex-bond bill of entry, that rate is to be taken. And on the basis of that rate, you determine the duty and you pay that duty. Fine, beta? Fine. No? Okay. Now, the next thing that we have is the baggage rules. Now, what are baggage rules? Firstly, baggage means what? So, baggage is your personal luggage. Interestingly, the custom law defines baggage saying that baggage includes unaccompanied baggage. So, it is defining baggage in an inclusive manner. So, baggage is nothing but what we call as luggage. Now, importantly, when we are talking about customs, if you remember in my first class, that is the previous class where we were discussing the basics of customs, I had informed that in case of customs, you need not pay tax only when you are purchasing goods from some other person. Even for your own goods, if you are importing or bringing into India, you may have to pay tax. And the best example is baggage. Now, if what we are going to study, had this not been there, then you would have been required to pay tax on all your luggage and packages. However, this baggage rule says that there is some extent to which you can bring the baggage into India without paying any duty. Only when you are carrying baggage exceeding the limits what are given over here, only in those cases you will be required to pay tax. Otherwise, you are not required to pay tax. Now, for the purpose of fixing the baggage allowance, we call it as the baggage allowance. That is the amount up to which you can bring the luggage or baggage without paying tax. Now, this baggage allowance, what it will depend upon the class of passenger, from where he is coming, for what period he has stayed outside, etc. All these things will determine the baggage allowance. So this is the table. I'm just not going through it because it is just you can say reading out the table only. So I'll request that you all please go through the table so that you'll get to know what are the different baggage allowances for different types of customers. Customer means passengers. Similarly, for our crew members, baggage rules also apply to crew members engaged in foreign going conveyance for importation of their baggage when they are finally paid off on termination. So many times these crew members, they travel to multiple countries along with their flight and they stay outside, and after that their entire journey is completed, which may be after 15-20 days. When they again come back to India and they are given a temporary break, at that time they clear all their baggages. Now their baggages may be containing so many articles which they may have purchased from different countries. So for them also the same baggage provisions applies. However, crew members of a vessel aircraft are allowed to bring items like chocolate, cheese, cosmetic and other petty gift items for their personal or family use up to a value which should not exceed rupees 1500. I personally believe these values, whatever you will see, are very old. Today you will not find anything very substantial in this. So these have to be revised, but fine. As on date, these are the values. Now, what is unaccompanied baggage and why you have a separate category? Now, we just saw above, the above table gives you a allowance that is up to a certain limit. Your baggage will be cleared without any tax. And in that, mainly whatever are your personal use items and all, they are always cleared free. But at times it may happen that for some practical difficulty reasons, your baggage may not be coming along with you. It is either coming before or it is coming after you have come. This is what is called as unaccompanied baggage. So what is unaccompanied baggage? Firstly, if you remember, as I said, the definition of baggage under customs says baggage includes unaccompanied baggage. It means the custom wants to give the same treatment to an unaccompanied baggage, what they want to give to the baggage which you bring along with yourself. So where you are bringing baggage along with yourself, no problem. But where this baggage is coming separately, that is either before your arrival or after your arrival, then this question will arise as to how it should be treated. Firstly, the law says it will be treated like baggage only, means the same baggage allowance will be allowed. But in order that it should be treated like baggage, and this baggage allowance should apply to that also, for that purpose, some conditions have to be satisfied. So what are they? Above provision, that is all the entire baggage, concession or allowance, are applicable to unaccompanied baggage also, unless specifically excluded. So in general, they will apply. Now, if unaccompanied baggage has been in possession abroad of passenger and is dispatched within 1 month after the arrival of the person in India. So maximum, if your baggage is sent after you have come to India, maximum it should be 1 month, which may be extended. Similarly, unaccompanied baggage can also land in India up to 2 months before your arrival. So first you have sent your baggage and later on you are arriving. This should happen in with 2 months gap only. Within 2 months, you should also arrive. Again, this 2 months may be extended due to circumstances beyond control up to a period of 1 year. Like let us say there is some war. For example, today we are having a huge war-like situation. So you had earlier you had planned a travel. So first you sent your baggage and you were supposed to travel in 1 month's gap. But suddenly this war broke out. There were many travel restrictions, or you out of utmost caution have cancelled your travel plans, but the baggage has already landed in that country. In such a case, this particular time of 2 months may be extended up to 1 year. Owner of the baggage is required to make declaration, which is called as the baggage declaration form. So see, like how in case of regular import and all goods and cargo, you file the bill of entry for clearance. Here, since you are bringing the baggage along with yourself, you don't need to file a bill of entry. Instead, you file another document for getting your baggage cleared, which is called as the baggage declaration form. And you have to disclose all the contents that you are carrying in your baggage, even if it may be your daily use articles, whatever, because everything has some condition above. It may be a duty-free allowed item, but still if you have to declare, if you do not declare it, sorry, and later on it is found that that article was there in your baggage and you had not declared it, even though it was otherwise allowed to be cleared duty-free, now there may be duty fine penalty imposable on that. Most important, it will be leviable to tax at the rate in force on the date of such declaration. Presently, there is a standard rate given for baggage. So whatever you are carrying in baggage, the rate applicable to baggage presently is 35%. Fine. So these are provisions, the procedural provisions relating to baggage and the other imports. Now we go to another procedural part, which is, you can say, extension of the previous chapter, that is warehousing. Now we studied in the previous chapter that when goods are reaching India, let us say the goods come at the Indian port at Mumbai. So your ship is coming to Mumbai. You are staying in Indore in Madhya Pradesh. Now you are getting your goods cleared at Mumbai port. First, you want to immediately bring it to your factory. Possibility 1, fine. Possibility 2 is you do not want it immediately, but there is a problem. The problem is the customs allow maximum 30 days for the goods to be at the port. So where the goods landed, it can remain at the port for maximum 30 days. If within 30 days you are not clearing the goods from the port authorities have the power to confiscate and then later on sell it by way of auction. Now, you want these goods, but you are not in a position to take it to your factory for whatever reason. Or let us say you do not require all the goods at the same time. Now, taking it to the factory means immediately paying off all the duty and taxes applicable. So there is a facility in the customs law itself whereby you can defer the duty payment of these goods by following the warehousing procedure. So what is this warehousing procedure? We call it as a warehousing procedure under customs. In this case, your goods which are landing at the Mumbai port will get cleared from the Mumbai port within those 30 days timeline, so that no such issue happens there. But you are not clearing it for bringing it to your factory, which we say you are not clearing it for home consumption. Rather, you are clearing it for just removing it from the port, and still the goods will remain in customs custody. How? The customs has a provision whereby there are custom ports. What are these customs ports that we are going to discuss? Sorry, not ports, the warehouses. So there are these custom warehouses, the different types of warehouses we are going to discuss, where the goods may be kept. So after removing it from the port, the goods will be kept within customs control only in the custom warehouses. And from there, whenever you want and in whatever quantity you want, you can withdraw by following the procedure of withdrawal and making the payment of necessary duty, interest, warehousing charges, whatever applicable. Now, with this background, let us understand the warehousing procedure in detail. So first is we have to understand the types of warehouse. What are these types of warehouse? First is the public warehouse, which is section 57. What it says, it is a place, you can say it is like a government property. It is owned and controlled by government. That is what is a public warehouse. And then there is another place which is called as private warehouse. Private warehouse is your own warehouse, but it is licensed with the customs. You have taken license. Now, in both things, in both the warehouses, what is common is your imported goods before payment of duty can be kept. The only difference is public warehouse can store goods of any importer. Private warehouses are mainly for your own purpose. Yes, in special circumstances, the board may allow other importers' goods to be kept over there, but otherwise it is mainly for your own goods only. So you're a regular importer, you have regular imports and you require the warehouse. So you may have your own warehouse built in that particular place only for your goods, but it is licensed with the government so that you get the benefit of warehousing provisions. Now, in both cases, they are under record-based control. So what is record-based control? See, one is physical control. Physical means where the custom officer will sit over there with all the lock and key with them. And in case of record-based control, the warehouse keeper is taking the control over it, or in this case, you are taking the control over it, but they are controlled through records by the department. That is, all records, all returns, everything have to be done periodically. Now, what is the warehousing procedure? Now, once your good come to Mumbai port, they are unloaded from the ship, they go to the port trust authority or the custodian. They are kept with the custodian. You file bill of entry. But this bill of entry is called as into bond bill of entry. We select that bill of entry option, which allows us to remove the goods from warehouse and keep it, allows us to remove the goods from the port and keep it in the warehouse. What is this procedure? The procedure is when you file this bill of entry, the assessment is done, but you don't have to pay the duty. You have to only compute the duty and multiply it by 3 to find out the amount of bond and security that you need to provide. This bond is called as the warehousing bond. And only on the basis of this bond, after giving this bond only, you are allowed to keep the goods in the warehouse. That is why the custom warehouse are also called as bonded warehouses, because here whatever is kept under the cover of a bond. Now, in this particular case, further what happens is once you provide this 3 times of duty, value, security, and bond, your goods will be allowed to be removed from the port and kept in that warehouse. Similarly, if afterwards you want to shift the goods from one warehouse to another, that is also allowed, and all this can be done without paying a single rupee as duty. Yes, you have to give the bond. Now, the bond can be a specific bond or a general bond. Sorry. Specific bond is the bond for that particular consignment. General bond is a running bond. I'm a regular importer. So what I will do, I will give one single bond of let us say 100 crores to the government. Now today my first consignment has come, for which the 3 times duty comes to 60 crores. I will debit 60 crores in this bond passbook, you can say. So out of 100 crores, 60 crores is used. After a few days, my other consignment comes for where the 3 times duty is 15 crores. Again, I will debit this general bond with 15 crores. Now, out of my first consignment, I am withdrawing some goods. I will run the procedure. I'll pay the duty and I will withdraw the goods from the warehouse. In such case, I'll again credit the bond with that proportion amount, because to that extent I have completed my compliance. So that is what is running bond, where I give a lump sum amount, I give a single bond, and I keep on debiting, crediting that bond, so that every time I need not follow a separate procedure. Now, within this entire bond procedure or the warehousing procedure, this part is the most important part. So when I'm keeping goods in my warehouse, I am given a particular responsibility up to what period I can keep the goods. What is this permitted period? So the permitted period is goods for use in any warehouse where manufacture or other operations are permitted under section 65. Now what is section 65? Section 65 is where you are allowed to do manufacturing within the warehouse. So this is again a special provision under customs, whereby you import the raw material, you do the processing of the raw material into final product in the warehouse, and from there itself you export the final product. This is what is manufacturing within the warehouse. Now, where you are doing manufacturing within the warehouse, you will require some machines to be kept in the warehouse, which can be used for manufacturing, and they will be used again and again. So that is why this provision says where capital goods are kept in the warehouse under section 65 provisions, in such cases there is no time limit, you can clear it anytime. Similarly, other goods like your raw material, your consumables, spare parts are kept, again for that there is no time limit for removal. But for all other goods like normal imported goods which are kept there and later on they have to be cleared for home consumption, or they have to be again re-exported, the timeline is 1 year from the date permitting the deposit. So from the time the goods have been allowed to be deposited, from that date up to 1 year, you can keep the goods in this warehouse. This is what is the timeline. Now, interestingly, in case your goods are removed within the timeline, the question is, at the time of removal, what you will pay? One, you will pay the applicable customs duty. Two, you will pay the warehousing charges, because you have warehouse, you use the warehouse. Let us say it is a custom public warehouse or some other private warehouse which you are using. You have to pay the warehousing rent. But interestingly, you also may have to pay interest. Now, this interest is very interesting. What is the interesting point? The interesting point is that why interest? The reason is, you imported goods today. I allowed you to keep the goods in the warehouse up to 1 year, and let us say you have kept it for 11 months, and you remove the goods after 11 months. So practically you are delaying the duty payment for 11 months. What the government could have got immediately today, duty, the government will get after 11 months. This is where they are giving you this interest burden or interest charge, whereby you have to pay interest. Now, what is this interest provision? It says that capital goods and other goods for use in a warehouse where manufacturing or other operations are permitted. That is under 65 where goods are kept. There is no time limit also for keeping and removing from warehouse. And importantly, there is no interest also. So no interest is payable in such cases. Then there is goods other than first case. That is not for operations, manufacturing within warehouse, not for that. In such cases, you are allowed to keep the goods in warehouse up to 90 days without interest. But since you have total timeline of 1 year, you can keep it up to 1 year, right? Now, in this 1 year, if your goods are kept beyond 90 days, so once they are beyond 90 days, for the period beyond 90 days, you will be required to pay interest. So what is important is, Up to first 90 days, no interest. Thereafter, after this first 90 days, you will have to pay interest. So even though you are allowed the total timeline of 1 year, up to 1 year it is allowed, but within that timeline of 1 year, beyond 90 days, if you are keeping the goods, you have to pay interest. The rate of interest is 15% per annum. Interest will be on the amount of duty payable at the time of clearance, and the interest will be computed from the 91st day till the date you are removing the goods. Now, till the time your goods are kept in the warehouse, you have certain rights over those goods as an importer, as an owner. What are those rights? You can go and inspect the goods, whether the goods are in good condition. If they are getting deteriorated, damage, you are allowed to change the packing, to do such things which will help protect these goods. Next, you are allowed to sort these goods, that is, do sorting, keep it in different places, and also you can bring your customers inside to show them the goods for future sale. Important. Now, this is that section 65. You are allowed to do manufacturing operations within the warehouse. This is what we discussed above also. Now, let us say you have imported raw material. So what you are a garment manufacturer. You import fabric. That fabric, you will be doing cutting, stitching, and making the final garment and exporting. Now, you are allowed to set up a whole manufacturing facility within the warehouse under section 65. So let us say you have done that. So what you have done, you have set up entire manufacturing facility within the warehouse. Now, in this particular case, where the manufacturing facility is set up within the warehouse, you are bringing this raw material, let us say some imported fabric coming from Bangladesh and coming from other cities, countries. In that manufacturing facility, under the provisions of section 65, you are now doing the manufacturing process. Now, in this manufacturing process, what you are doing is you are converting that fabric into garment. Now, when you are doing this, there would be some waste which would be coming out in this process, which is very common. From any manufacturing, you will have waste. Now, once you will have waste, what is the treatment of waste? That is what is important. Whether you have to pay duty on the waste or not, that is what is important. So for this, what does the provision says? It says that if whole or part of goods resulting from such operations are exported. So whatever is your final product, that is the garments in my case, if those garments are exported, then the duty on the waste will be remitted, provided you either destroy the waste or you even export it. So you are exporting final product, you export the waste also if possible. If not, you destroy the waste. I will remit the duty which is applicable on the imported goods, that is the entire raw material. If not, if you want to remove the waste into India, then you pay the duty and remove. Second, if the final product you are going to clear for home consumption, that is, you are going to bring the final product in India, in that case, there is no benefit for the import duty applicable. You have to now pay the import duty. Next, removal of goods from warehouse. One, it can be removed because you want to shift it to another warehouse. Second, finally for your home consumption. Third, you want to export it. Now, allowance in respect of volatile goods. I had kept 1,000 tons in the warehouse, but when I'm removing, out of 1,000, I'm only getting 980 tons. 20 is not there. Now, when any lesser amount is removed from the warehouse, you are supposed to pay the duty of goods you're removing. That is fine. But what about this 20 tons in my case? If this 20 tons is a natural loss because the goods are volatile over a period by storage, that much quantity is getting evaporated and all, the ACDC may remit this duty. If you remember, in the previous class we had studied, we had provisions of remission under 13 and 23 both. So similar to that, you have a provision here also. Yes, Beta Swaminathan, you had raised your hand.
Yes, sir. Sir, on the warehouse, when we stored the goods, we have the facility also, the manufacturing goods of that. That
Sorry,
time,
when we store the goods in warehouse, we have what facility of manufacturing?
yeah, manufacturing facility.
Correct.
Yeah, yeah, can you go up to the slide, sir? One more slide, the 2.26 about. Yeah, here sir, we need to pay, on the waste. We need to pay the duty as well.
Correct.
See,
Correct.
sir, my question is that
Hmm.
we are allowed to store up to 1 year, the 90 percentage, beyond 90 days, that rate of interest will be, we need to pay 15%. That is okay.
Hmm.
And my question is that before paying the duty,
Hmm.
now goods are at the warehouse. Uh, can we do some manufacturing activity there before payment of duty?
See, so you are allowed manufacturing. Now you have to follow the Section 65 procedure.
Okay.
See, you are allowed to do manufacturing. That is what is 65 says. But for that, you'll have to take special permission. You have to give a special bond for that. So manufacturing is allowed as per Section 65, but for that, you'll have to take that permission first.
Okay, sir. Okay, sir. My question is that that is the reason. Upon the removing the waste, we need to pay the tax, right?
Correct. So if you are going to remove your final product within India, then you have to even pay the tax on waste. That is
Okay,
what is the point.
because of that, the entire what are the material available, we did not pay the duty. Hence,
Uh,
the duty is applicable for both the waste, good and waste, right, sir?
correct.
Okay,
Because
that
see, whatever will be cleared in India, you have to pay duty. That is a simple logic, beta.
okay. See, I'm just thinking what is the logic behind on it. Okay, since
See, so
the
logic is
duty,
you are clearing those goods in. See, you had imported it first thing. They were
okay,
kept in warehouse. But once you are bringing it into India, you have to pay duty, na?
yes, sir.
That is the logic. Had you exported it, which is one of the other provisions, had you exported it, no duty then, because if it is going outside India, then we don't want duty.
Okay, this is the first time I am hearing the manufacturing facility. They are allowing, they are giving the
Nay, there is
license.
such a special facility under
Okay,
Section 65.
yeah,
Yes.
okay. Okay, thank you, sir, for this.
Okay, fine. So with this, we completed warehousing chapter. So let us, before we proceed, take a break. So now it is around 7:53. So around 8:05, we again catch up to complete the remaining two chapters. Fine.
Fine, sir. Thank you, sir.
Thank you. to this point, whatever we have discussed, studied till now?
From my side, no, sir.
Okay, great. Oh, fine. Now, we go to the next chapter, that is refund under customs. First, who is eligible to claim refund? Again, you have to remember one thing always in case of the indirect taxes. If you remember, we had discussed this when we were discussing GST refund chapters 2 sessions back. The concept is the theory or the doctrine of unjust enrichment. Only the person who bears the duty incidence, who has not passed on the duty incidence, is the person who is eligible to get the refund. Otherwise, if the refund is maintainable, but the duty burden has been passed on by you, you will not be given the refund. The refund will be transferred to Consumer Welfare Fund, because following the same principle, same doctrine, even the government cannot keep the amount if the refund is eligible as per the refund provisions. Now, who will get the refund? The person who has paid excess tax, obviously. So wherever the tax which is wrongly paid, which was not required to be paid, but because of some wrong calculation, assessment, tax was paid in excess, then the actual liability, that tax has to be refunded. What is the time limit for making this refund application? It is 1 year in regular cases, and where it was paid under protest. What is paying under protest? You yourself at the time of making payment mention that I am not sure whether this duty payment is applicable or not, but I don't want to take a chance. I don't want to fall in the category of a person who has not paid the tax. So I am myself paying this tax, but I do not agree to this. Hence, I am paying this under protest. That is what is duty payment under protest. If that is done, and you at the time of making payment itself, you mention it to the department that is payment under protest, for which no time limit is applicable. Next, where the amount of refund is less than 100, the law says please don't file. We will not entertain, because it is too small amount to run the entire procedure of refund. Next, doctrine of unjust enrichment, amount refundable will be created to Consumer Welfare Fund in case the burden has been passed on by you. Now, situations where refundable amount is given to you and not transferred to the Consumer Welfare Fund. So when will you get the refund instead of it being transferred to Consumer Welfare Fund? First, if you may be importer exporter, have not passed on the duty incidence, or buyer who has purchased from you and you had passed on the duty incidence has not further passed on the duty incidence, or where the imports are for personal use. So when it is personal use, there is no question of passing on the duty incidence because you are using it yourself. In case of export, generally we do not recover the export duty. We do not pass on the burden. So export duty refund will be given to you. Drawback will be given to you. Duty interest, which is borne by some notified applicant, and duty paid in excess by importer before order for clearance of home consumption is passed. This generally happens wherever there is remission on account of pilferage, etc. In such cases, when you find that at the time of removal, there is some shortage in quantity which is due to pilferage, you can ask for refund there itself. Now, what is the rate of interest that you will get when you are getting the refund? The rate of interest will be 6%, but this will be applicable only if you are getting the refund beyond 3 months. That is when there is a delay by the department in making the payment of refund, and the delay is beyond 3 months from the date of your making application. Refund of export duty, when this will happen? This will happen when you had exported the goods originally, which are returned. Now they are returned. Why? Because they are rejected, there is some defect, and that is why they are coming back. They should come back within 1 year from the date of export, because that is a reasonable time within which you should get back a goods. If somebody is not accepting your goods, this is sufficient time. You should get the goods back. Application made before expiry of 6 months. So the time limit for making application is also mentioned here. It should be made before the expiry of 6 months from the date on which proper officer has allowed clearance of goods for export. Similarly, refund of import duty conditions. Goods are defective, not as per specification. Goods are identified as import goods. No drawback is claimed. So what is this point? This point is importer exports the goods or relinquishes the title to the goods or destroys or renders them commercially valueless. So at such times, the import duty which you had paid shall be returned back to you. Application should be made before the expiry of 6 months and no refund if it is of perishable goods. Now, these timelines will be computed from relevant date. Like if you remember the timeline for normal refund, which is 1 year from relevant date. What is the relevant date? First, in case where the goods were exported, the date on which the proper officer has made the order for export. If you had relinquished the title to the goods and hence you are asking for refund, in that particular case, it will be the date of such relinquishment. Where the goods are being destroyed or rendered commercially valueless, again the date of such destruction. So this is what is the provision relating to refunds. Now, the next chapter, or you can say the last chapter in this customs syllabus, FTP. FTP is foreign trade policy. Now, first is what all things are covered in foreign trade policy. That is what is the content of foreign trade policy. First, you have the last announced foreign trade policy, which was in 2023. It was supposed to be revised in 24-25, but somehow it has not been revised. So we still have the FTP, that is foreign trade policy, last announced in 2023. Then you have the handbook of procedures and you have the ITCHS classification import export items. Now, what is FTP? See, we sign different agreements, different trade agreements with multiple countries. You would be seeing many times our prime minister traveling, our foreign minister traveling, many times other countries' counterparts coming to India, and we are having different types of bilateral agreements with them. Many times these agreements majorly are on trade. And in many of those agreements, there is an understanding of providing some relaxation, some concession, or fixing some quota. All those things are what are decided. Now, all these things together with whatever the Indian government wants to provide to the exporters so that the export from India is increased, it is getting some support. All these things together make up your foreign trade policy. So one is our bilateral agreements with different countries. To the various schemes, various benefits which our government is allowing in order to promote exports. Now, what are these export promotion schemes as on date? So different export promotion schemes as on date are: first is duty exemption schemes. In this, you have advance authorization or duty-free import authorization. Now, what is this duty exemption scheme? As you can understand from the name, at the time when you are importing the goods, at that time itself, you don't have to pay the duty. That is why it is exemption. And then within that, there are two categories. In fact, there is one more category you can say, which is EPCG, though they have covered it separately, but it is also similar. It is exemption scheme. Then you have the duty remission scheme. What is remission? The remission is you first export, and after exporting, we will give you back whatever taxes, duties you had paid at the time of import or you had paid on locally procured items. That is what is drawback scheme. Then you have scheme for remission of duties and taxes on export products. You have the capital goods import scheme without payment of duty, which is EPCG. Then we set up these special zones, I will say, or we give them the special status of EOU or electronic hardware technology park, software technology park, so that they can do the business without the local tax incidents. And then we have this concept of deemed export. Remember one thing, students, we have the similar concept of deemed export in GST, but the GST concept of deemed export and custom concept of deemed export are different. Now we go to these schemes in detail. So first is the scheme which is under the first category of duty exemption, right? Now in that you have advance authorization, you have DFIA scheme. Now what is both these schemes? In both these schemes, one thing is common. When you are importing some raw material means other than capital goods, because for capital goods you have the EPCG scheme. So whenever you are importing something which is not capital goods, which is raw material, packing material, consumables, and these you are going to utilize in manufacture of those final product which you are going to ultimately export, then you have a special benefit under this category called as the advance authorization scheme. So under the advance authorization scheme, what happens is at the time of import, if you have taken this advance authorization license or this DFIA license, then you import the goods by giving that license. And then you take these materials to your factory, you do manufacturing, and you export the final product. Now, when you're exporting the final product in the shipping bill, you mention the details of this license, details of these imports that you have done, so that it can be linked, because under these schemes, there is a requirement which is called as export obligation. So whatever goods you are importing duty free, to compensate for that duty free or the exemption which is given by government, they have put the condition that you have to make these many times. So they have given it in multiple. So whatever duty saved multiplied by 6 times, that much value of export you should do. And again, they give you the timeline within which export should be done. So this is how both these schemes operate. Now, comparatively, what is the comparative points? First, advance authorization, duty-free import of inputs, which will be used in export products. In return, exporter needs to fulfill the export obligation. Similar to this, you have to again, you can duty-free import, and in return, you have to fulfill the export obligation. The main difference is non-transferable, transferable. Actual user, no actual user. Now, both these are complementary conditions. So where it will be non-transferable means what? Whatever you have imported, you have to compulsorily use it yourself. You cannot give it to others. And that is also what is actual user condition, means only the person who is going to use it can import it. So if I am importing in excess, which I do not want, I cannot sell it to anybody else. And if I do that, I'll have to pay the import duty, which I had taken as exemption or concession. Whereas in DFIA, it is transferable. So the imported goods which were imported duty free, you can transfer it, and hence there is no actual user condition. Here, there should be minimum 15% value addition. So whenever you are exporting, you have to ensure that your export value is at least 15% plus of the total cost that is incurred on your imports. And here it is 20%. Then you have these other schemes. Now, EPCG is, you can say, very similar to advance authorization. The only difference is that EPCG is for importing capital goods or even procuring them locally without making the payment of taxes and duties. So when you're procuring locally, you don't pay the IGST or the GST component. And when you're importing, you don't pay the basic custom duty and GST. And again, in return, you have to make the compliance of export obligation, which is duty saved multiplied by 6 times. Second type of scheme is where you are given one of these status, 100% export oriented undertaking status, or electronic hardware technology park, software technology park, or this BTP. All these are different statuses which are given to you. Now under this, once you're under one of these statuses, what basically you will be required to do is you are again required to make exports. But in that case, the benefits that you are getting is you can import goods or procure locally either capital goods or inputs without making payment of duty. Second, in return, you must export the entire production of your good service except to some minimum limit of domestic sales. Most important, trading units are not covered. In other words, all these have to be manufacturing or service provider. Deemed export. Goods which are manufactured in India supplied to specific projects or consumers. So in this case, the goods actually do not go out of India. Payment is also received in Indian currency only, or at times Forex, because you are supplying it domestically. But what you are supplying to, that person is going to further export or use it in some specific project. That is where they are given the status of deemed export. And all types of benefits on that particular thing is provided. So these are some important schemes that are there. Let me just take one more chapter that is relating to classification. Just open the classification chapter. Okay. Now, what is this chapter of classification? Let us understand this. See, classification is what? When you are importing or exporting goods, you need to determine the correct rate of duty, maybe even tariff value, and also the relevant other schemes which are applicable, the relevant exemptions. Now, all this is linked with the HSN. HSN is the Harmonized System of Nomenclature. So what is this? See, when initially import export were happening in early 60s and 70s, when the volume was very low, only specific countries were doing that and only of very limited goods, this need did not arise. But post 1970s, when slowly international trade increased, different mediums of transport started, we started importing oil because the use of crude oil increased in our day-to-day activities. In such cases, the rise of international trade led to a practical challenge of how to identify what one is selling and what one is buying, and also trying to bring parity, trying to bring uniformity in the nomenclature. Nomenclature means the names. So, what I may call as a slipper, in India, slipper may mean a footwear. We call a footwear as a slipper. But the same thing in Japan may be the rooftop. The same thing may be in US, may be representing some package material. Now, the point is, even though all are using English language, within English language, the same word has multiple meanings. Like, if we say bill, in India, by bill, we mean invoice. But in US, they refer to their currency note as bill. So again, we have multiple meanings of the same English word. So it is not about the difference of language. It is about the usage of those words in different countries. Now this created a lot of problem. So the WCO, World Customs Organization, like how you have WHO, WTO, we have the WCO. They came up with a standard list, you can say, of names, saying that, okay, now onwards, these names have to be used by you when you are doing international trade. And for every name, they gave a code number. That code number is called as HSN. So that tomorrow you can easily use it in computers. Like computers are more comfortable using digits and numbers, we as humans are more comfortable using names, but in any type of systems and all digits and code numbers are more usage. So they gave a list of names, and along with the names the relevant code number, so that easy identification, easy communication is possible. And tomorrow and today entire international trade is using HSN. Now what they did is they listed down all the products which are there presently in the world, which can be traded, and they made a list of all these products, a standardized name list, which is why it is called as HSN. system of nomenclature, and harmonize means standardize and common for everyone. Now, since these names are running into lakhs, for better identification and handling, they divided this into chapters, which are presently 98 chapters. And let us just visualize, this is a whole book having 98 chapters, and these chapters are further divided into sections. So what are sections? Similar group of chapters under section 1, other similar group of chapters under section 2. So we have 21 sections. So there are sections, each sections having few number of chapters, and the entire list of goods is divided into this. Now again, there is a chronology. The initial chapters, chapter 1, 2, 3, 4, up to 10, 12, are all dealing with goods which are in their raw form. So all types of raw items, raw vegetable, raw milk, raw fruits, raw flesh, all these things in raw form are in the initial chapters. And then slowly, as the processing happens, the chapter increases. This is how you have 98 chapters and you have 21 sections. Now, there are 6 digits in HSN. I'm sure you all would have studied 8, but that is where India has added 2 more digits. So by WCO, they have given 6 digits HSN. We have added 2 more because we needed furthermore bifurcation. Like within mangoes in India, you have multiple varieties of mangoes. Now for them, mango is a mango. So for them up to 6 digits, they will cover mango. We have added 2 more digits to cover varieties of mangoes. So this is a simple example of how we are using 8 digit. Now, the problem that was created after this. So one thing became good, that now there is standardization of names. Everybody will use same name, same code numbers. But a new problem arose. And this new problem is that because of using standardized names, it became difficult for a business to identify, to exactly understand where my product fits. So let us say I am making a chocolate. Now you may not find a name in the entire 98 chapter by the name chocolate. I am, let us say, making a kulfi. You will not find a name by the terminology kulfi. So how will I identify, how will I find out where my goods are fitting in this? So this is where you also have the rules of interpretation. What are these rules of interpretation? The rules of interpretation are that whenever you want to search, you want to identify out of these 98 chapters and lakhs of goods description, where your goods are falling under which chapters, which heading, which subheading, you have to apply the interpretational rules. Similarly, you also have some explanatory notes to understand these rules or understand the classification. This is all what we study in this chapter. But before that, there are some general explanatory rules. What are those general rules? They have mentioned that basically you have 3 general explanatory notes that you have to understand. One is the system of dash. What is this system of dash? When you read this HSN book, I am using the terminology book where all these 98 chapters and all description of goods are given. While writing, they use dash. So when they're writing the main heading, they will use single dash. Within the main heading, if there are subheadings, they will use double dash. Within the subheading, if there is further subheading, they will use triple dash. So why they are using this single dash, double dash, triple dash? So that you will understand that that subheading belongs to which major heading and that major heading belong to which superior heading. So single dash represents the heading. So like how in a book we have different headings of paragraph, which is the main heading. And within every heading, you may have further sub points, and within each sub point, you may have further sub points. That is how single dash, double dash, triple dash, 4 times dash, all these things are used. Percentage. Now against each name, they have to give you percentage, they have to give you duty. Now the duty may be either as a percentage of value, or it may be in some terms of physical quantity like per kg, per liter, etc. Wherever the duty is given as a percentage, it has to be always interpreted as percentage of the value. So I have to multiply the percentage by the value which we studied in the valuation chapter. Then there are two columns for rates of duties. This again, if you remember, we studied in the previous class, in the initial chapters that we studied. That is standard rate and there is preferential rate. So what is standard and preferential? So there are two columns. Standard rate means the rate applicable to all goods, all countries. And preferential is exactly next to the rate of standard rate. So let us say for my chocolate, the rate is 30%, which is the standard rate, but preferential rate may be only 10. Now, what is this preferential rate? The preferential rate is where for certain countries where we have signed the special contract, special pact of giving them the special concession, for those country origin goods, you will be applying the preferential rate. Now, while interpreting or while deciding where your goods will fall under which chapter, under which heading, you have to apply the rules of interpretation. Now, broadly, there are 6 rules. Rule 1, which is the general rule. What does it say? Rule 1 says, don't go exactly by the heading use, because headings are just for reference purpose. What you have to see is the explanatory notes given under each heading. So when you read any heading, below the heading immediately you have some explanatory notes. So the first rule says go by the detailed explanatory notes. Then you have rule 2A dealing with the classification of goods which are in unfinished or incomplete form. 2B deals with classification of those cases which are mixtures or combinations of different materials. Then rule 3 is applicable where your goods are falling in more than one heading, applying the above rules. Then you have a general rule, rule 4. Then you have rule 5, which deals with classification of packaging items. And you have rule 6, which says what rules you apply to determine which chapter. The same rule will apply to determine the heading of the chapter and the subheading of the chapter. So this is how you have 6 rules. Now we go to each of the rules to understand in detail what the rule says. So rule 1, what it says. The titles given to the sections or the chapters or the sub-chapters are only for reference. They do not have authoritative value. So let us say the heading may say products made of chocolate. Another heading may say product made of milk. Another heading may say product made of fruit extracts. Now these may be headings, but that does not mean that you'll strictly go by the heading and say, okay, what I'm making is made up of milk only, so I will compulsorily classifying it under the chapter whose heading is products made of milk. Yes, there is a very good probability that it may be classified over there, but that is not the decisive factor. So in short, what they are saying is don't be 100% depending on the names used. So the titles or the names used are only for a reference to give you an idea, okay, your product may be classified here. Then the question is, then how do you determine? They say that for every chapter heading, for every subheading, we have given some explanatory notes. So they have given some explanation, like how under different provision sections, we read explanation which says, this is what it means, this is what it includes, this is what it does not include. Same thing. For these titles, these section headings also, chapter headings also, various subheadings also, we give explanations. What is given in the explanation is called as the section notes or chapter notes. So where the explanation is given to the section, that is you are having heading section 1, natural goods. Now within that, they will give you what this section will include, what it will not include. Within each chapter heading, they will again give you a list of what it includes, what it does not include. So you have to apply that. And that is what is having the legal value. In short, the first rule says go by the explanatory notes given under each section or each chapter. So the explanatory notes given under the sections are called as section notes. Given under each chapters are called as chapter notes. And that is where they clearly specify, okay, this is included in this or this is not included in this, and you have to apply that. So first step is to identify under which section, under which chapter your goods will fall. For that, rule 1 says go by the section notes, chapter notes. Now, in majority cases, you get answer by rule 1 because rule 1 is so specific that it says you read the notes, and many times the notes are very crystal clear saying that, okay, let us say, I'll give you example of playing cards. We have been using playing cards. Now, whether playing cards will be classified under products made of paper or it will be classified under toys. So that is where you have to read the section headings and the chapter headings, because in that they are very specifically mentioned where that particular playing cards will be covered, whether in products of paper or in toys. So first rule says go to the respective headings, read the notes to the headings to the sections, and that would be the deciding factor. 1. Rule 2, it further gives you second level guidance. Many times you have goods which are removed from the factory in incomplete or unfinished form. Best example is cycle. When you go and buy cycle from a cycle shoppy, you buy a cycle which is in the totally usable form, ready to use form. You can drive the cycle there itself to your home. However, when the manufacturer sends it or when an importer imports it from outside, these things, cycle is the smallest example. This applies to majority of machinery parts, majority of vehicles, that they are sent in unassembled form, which is called as incomplete or unfinished. I am using another parallel word, unassembled. It means your cycle is ready, but purposefully it is not assembled and fitted as a cycle. Why? Because the moment you do it, it will require more space for transportation. Instead, when you keep these parts separate, more cycles which is in unassembled form can be loaded in one truck. Same thing is with different machine parts. Once you fit the machine, it may be either of a huge length, heavy weight, which may be difficult for it to carry and even transport. So that is why many times they are purposefully kept in the unfinished form. So basically they are ready. It is the final product. You cannot say it has not become final. The only thing is final fitting and assembly is pending. Like today, when you order anything online, nowadays majority of your online products which are delivered to you are in this form, and you have to do slide some fitting and all, and it becomes ready to use. So this is what is rule 2A. Now, if any particular heading refers to finish or complete article, incomplete, unfinished, unassembled, disassembled will also get classified under the same heading. In short, a cycle, even though sent to you in unassembled form, so practically what is getting delivered is not a cycle, it is all parts separate, but it will be classified in the heading of cycle if it has the essential characteristics of the finished goods. So all these parts combined is finished goods only, but they are transported in this form just for ease of transport and handling. That is where rule 2A says unassembled, unfinished will be classified in the final product category only. They will not be classified in the parts, because physically what you're receiving is parts. But since it is in whole, the final product, you will classify it in the category of final product. Then comes classification of mixtures, combination of material substances with other material substances. Now, when rule 2B applies, where many times what you buy is a mixture of 2-3 items put together. Now, when these 2-3 items are put together and it is sold as a mixture or as a combination, the point will come as to where it will get classified. So rule 2B says reference to a material substance would refer to the mixture combination of that material substance. So for example, I'll give you a very simple example. The simple example of this is that when you buy some type of masalas, the masalas are mainly, let us say, it is a lal mirchi masala. But there may be some other very small ingredient which is just put in that masala for the purpose of preserving it. So the intention is to put that particular thing as a preservative, like many times salt is put as a preservative. So what you're buying is not salt. What you're buying is the main material, but there is some other material put in that, which is just for some preservative quality. Now, in such a case, what you are receiving, you can say it is a combination of different material substances. What Rule 2b says, when you are referring to any chapter where the heading gives names of the materials, Rule 2b says that material heading will cover all mixtures, all combinations made using that material. So this is reference to material substance would include reference to goods consisting wholly or partly of such material or substance. So where any combination you are buying, importing, that combination has, let us say, 2-3 materials. So you will go by the classification of the material itself. So where it is combination of materials, like many times, as I gave you example of masalas, many times masalas are classified in that one main material category to which that masala belongs. Now, this rule 2b may not be always applicable because since there are 2-3 materials, it may get classified in each of the material chapters because each of the material is there. That is where rule 3 comes. So rule 3 comes where classification of the goods as per the above rule makes them classifiable under 2 or more headings. Same example of this masala. So masala is having 3 different ingredients. That is how that mixture is given to you. Now, haldi also has a chapter, lal mirchi also has a chapter, and salt also has a chapter. You are given a combination of this mixture of this. Where will you classify it? As per rule 2b, it has to be classified in the material itself. So this masala can be classified in the chapter of haldi also, in the chapter of lal mirch also, and in the chapter of salt also. Out of this, where you will classify? So this is what rule 3 guides. Rule 3 says, first rule you have to follow is specific over general. Example of this is, you have something called as mango lassi. When I say mango lassi, there are, by default, the name suggests there are 2 different ingredients. One is mango, one is lassi. Okay, so where a crude example, I'm giving mango lassi. So lassi is there, and in that you have put mango pulp or you have put mango essence. Now I'm taking example where you have put mango pulp. Now it is a mixture of 2 items. Now let us say one chapter is covering lassi, one chapter is covering mango pulp, where it will get classified. So that is where you'll use rule 3. Rule 3 says that many times where it is classifiable in more than 2 headings or more than 1 headings, you will or you should classify it in that heading which is more specific as compared to that heading which is general. So like simply saying masala is general and saying haldi based masala is specific. So where something is majorly haldi based, that heading is specific as compared to simply saying masala. So masala is a general terminology and haldi based is specific terminology. So first, for such combinations where there is more than one chapter available, apply the rule 3a says, which says use the specific chapter or the heading which has more specific description. Let us say in case of mango lassi, both mango and lassi both have specific description. Then what? Then apply 3b. So in mango lassi case, more than 3a, 3b applies. It says go by the essential character rule. What is essential character rule saying? Out of both these items, which both are specific, which one is giving the main character to your product? So in my example, it is the lassi which is the main character because mango is only put or used as a flavoring item. In this case, applying 3b, I will classify this mixture in the category of lassi or curd based products because it is satisfying 3b condition of giving the more appropriate nature or character to that product. And where this also fails means both your headings are specific and also both the items are giving the character, because both are equally important in that mixture. When all the rule fail, then you go by a residuary rule which says latter the better. What is latter the better? In this rule, what you do is you take that particular classification as the answer, which comes later in the sequence. So you have chapter 1 to 98. Within each chapter, you will have headings. So wherever your product is getting classified in 2, 3 different headings, and you are not able to decide from 3A and 3B, because 3 and 3B is also giving multiple answers, then you put the numbers. So from 3A, 3B, you will get multiple headings where your product can fall, applying the specific rule or applying the essential character rule. Now, out of these headings, use that heading which is sequentially the last. That is what is latter the better principle. If all these rules fail, why or when this will fail? When your product is something a novel type of product. Maybe that product is not yet envisaged in the classification itself because something new has been made. Now, in such a case, or let us say what you are importing is maybe made in those foreign countries, not in your country. So maybe exactly that description is missing in our classification schedule. Then how do you classify? They say you classify using the Akin good principle. What is Akin? Akin means similar. So I may not have the exact description of that product in my this classification. Like for example, smartwatches, when they were not there, there was no concept of smartwatch or that particular name in the entire 98 chapters. Now, when smartwatch were initially introduced, now you have a special entry for smartwatch, but when they were initially introduced, there was no classification heading for that. So we were applying rule 4 and trying to classify it in that goods which will be similar to a smartwatch. So we were firstly classifying it in the watch itself, because a smartwatch, even though it is smart, but basic purpose of that watch is to be used as a watch. So where the above rules fail, you have to classify it in that chapter, in that heading, which is more nearer to your goods. So where specific headings are missing, same type of goods or categories are missing, use this Akin principle. Then coming to rule 5, this rule 5 is applicable for classifying the packaging. Now, for this, just take some examples. When you go to buy jewelry, the jewelry is given in a special jewelry case to you. When you go and buy any product, these products are put in some boxes, put in some packages and given to you. Now, there can be two types of packages. One, a general purpose packing, and one, a very specific packing, like a jewelry box packing is such that it can be used only for jewelry. But when you go to buy shoe is kept in a box, a simple this paper box. That paper box is used to keep so many things. It may be made in the shape of the shoe itself, that is to keep a 10 size shoe and an 8 size shoe, but ultimately that box is a general purpose box because that box is used in other industries also for keeping the goods. But a jewelry type of case is used only in jewelry industry to keep the jewelry items, and that also for different jewelry items. For necklace, there is a different shape. For earrings and nose rings, there is a different shape. For bangles, there is a different shape. So within the jewelry box also, you have more specific jewelry box. So the point is, these are special purpose packing. What does the rule says? Where such type of cases are there which are to be used or designed to be used only for holding or keeping a particular type of goods, the classification of the package will be in the goods itself. So example that are given over here, camera cases, musical instrument cases, etc., to be classified with the specific article So they will be classified in the camera heading itself. They will be classified, in my case, in the jewelry heading itself. But where it is a general purpose packing material or packaging material, then you will classify it using the rules of classification, and it will get classified like if it may made out of box, it will get classified in the paper product headings. If it is made out of wood, wooden boxes, corrugated boxes, plastic boxes, it will get classified in the respective category. Most important exception to both these rules, when packing material itself gives the essential character as a whole, and here durable containers capable of repetitive use to be classified separately. So these are some exceptions to the rules. Then coming to rule 6. Rule 6 is what? You will apply above all the rules first to decide the chapter heading. Once you've decided, you come to know, okay, my goods out of these chapters will fall in this particular chapter. Now rerun the same rule to decide under this chapter which heading it will get classified. After deciding the heading, under which subheading it will get classified. So for every stage classification, you have to apply the above classification or interpretation rules. Then you have a concept called as project imports. What are project imports? Where imports are done. Now it will be multiple items coming, different machines, different parts, but they all over here will make up one single unit like a power plant. So what you want to make is a power plant, but to set up a power plant, different types of machine, different types of items are imported, some are locally procured, and all these things together will ultimately make one single unit, which is a power plant. Such things are called as project imports, where different things are coming, but they will be ultimately making up one single entity unit. Now for such project imports, you have a separate classification. What does the classification says? All items imported under project import, irrespective of their respective headings, will have one consolidated rate of custom duty. So in short, for project imports, like how in GST we have the concept of composite supply and mixed supply, here also you have a similar concept called as project import, where there is a specific category of rates given for project imports. Individual exemption notification is applicable even for items grouped under project imports. So this is all about classification. In fact, this is all about the entire customs chapter. So we have completed the entire provisional part of our customs and in fact the whole indirect taxes. Now we have 2 more sessions left as per our schedule, in which we will cover up some practical aspects from these chapters what we discussed. Also, we will cover the different statutory updates. So with this, it is a conclusion from my side, but I have our faculty, Chef Ali ma'am, HOD ma'am. So she would be now interacting with us. She would be sharing her insights with all of us. Over to you, ma'am.
Thank you, sir. Good evening, students. So as you are nearing the completion of your syllabus for indirect tax laws, and today you have covered so many concepts of customs in one class. So this was actually a very enriching class. And since you are nearing the completion of your syllabus, so I would like to share some of the insights with you regarding the, because something which students keep asking us is this still is the study material, that which is the study material which is applicable for the relevant examination, though I have shared it not many times earlier also that this is the November 2024 edition of the study material that is relevant. But apart from that, you need to know that the statutory update is hosted on the website. In fact, I will share the screen and I will show you the BOS knowledge portal. Just let me share the screen. Yes. So am I, is my screen visible to you all? Sir, is it visible?
Yes, ma'am. Visible, ma'am.
Okay. So on BOS Knowledge Portal, study material is there. November 2024 edition of the study material is relevant for September 2025 examination. In fact, for January 2026 also, this is the same edition which would be applicable. Apart from that, as it is mentioned here also, that May 25, September 25 and January 26 study material is relevant, which you have to refer along with the statutory update, which is hosted on the website in the section amendments. This is the indirect tax laws statutory update for September 2025 examination. So you have to refer your study material, which is November 2024 edition, along with the statutory update for September 2025 edition. But today I have shared this website to you all to show you that the revision test paper for September 2025 examination for final papers has been web hosted today. And I want to take you to the indirect tax laws revision test paper to show you what all is there in store for you, because now since you are nearing the completion of your syllabus, so you can refer the RTP questions also. So once you are through with all the concepts, because most of the concepts have been done, now you will be practicing the questions and you will be going through the statutory update. So you can go through the revision test paper questions also. In fact, when you are going through the study material, in the study material, the Finance number 2 Act 2024 amendments made by the Finance number 2 Act 2024, which became effective from 1st November. All of you know that they have been given at the end of the chapter because they were not relevant for May 25 examination. Now, for September 2025 examination, they become relevant because for September examination, the amendments made till 28th February 2025 are relevant, and all these amendments which became effective from 1st November 2024 will be applicable for September 2025 examination. So what we have tried to do in the revision test paper, we have tried to cover few questions based on the amendments specifically, and they will be covering the amendments on section 74A because it's a very crucial amendment which has taken place in demand and recovery chapter. So we have tried to explain you the amendment by way of a question which comprehensively covers the provisions of section 74A, which helps you in understanding that how the common provisions have been introduced in a single section for fraud as well as non-fraud cases, and how they are similar, at what places they are similar for fraud and non-fraud cases, how they are different, at what places they are different for fraud and non-fraud cases. But I will be starting with the first question itself. First of all, we have a case scenario based on which we have 6 questions, and that will help you in the MCQ portion or case scenario based questions which come in the examination. So 6 questions are there based on the first scenario. Then we have case scenario 2, based on which 5 questions have been asked. So I request all of you to attempt these questions once you complete your syllabus, because that will help you in brushing up your concepts. Then we have one scenario based on the customs law, and then comes the descriptive portion. So where the 13th question is the big question which comes in your examination, the first question, compulsory question, which requires the computation of net GST payable in cash. So this is the question which has been there, and then we have the amendment based questions. In fact, some amendments are there in the earlier questions also. But for this 14th question is based on the amendment which has taken place in section 16 subsection 6 of the CGST Act. That is, when your registration which was cancelled earlier has been revoked after the limitation period of 30th November of the next financial year, and your registration, since it was revoked or it was cancelled, so you could not file your returns, and that is why in case some of the invoices you have left on which you have not taken the ITC of the previous financial year, can you take it, till what time can you take it, and what is the procedure? So this amendment which has taken place by way of section 16(6) has been elaborated or explained in question 14. Then question 15, as I discussed with you, section 74A, it is based on section 74A and it elaborates the amendments made by section 74A. Next question is based on the amendment which has taken place in section 112, pre-deposit for appellate tribunal. And next question is on the amendment or two entries which have been introduced in schedule 3 of the CGST Act, that is the co-insurance premium relating to co-insurance as well as reinsurance. So this amendment has also been explained by way of the question, which is question number 17. After that, we have question number 18, 19, and 20 based on the customs law. So this is all about your RTP, and I advise all of you to go through the RTP, attempt the questions. Once you feel that yes, you have revised the concepts, or if you want to refer to the amendment based questions first because you want to you have already gone through those provisions of GST law, so you can go through the amendments based questions also first, and then you can proceed with the rest of the RTP. So this is all from my side. In fact, one more thing I want to share with you is that by next month, we'll be coming up with the Saransh for final papers. So all of you, since you are there for the final, you will be sitting for final examination September 2025. So Saransh, which is a pictorial representation or which contains the summaries, charts, flow charts, and diagrams encapsulating the concepts, provisions of the study material, that will be available for final papers in next month. So you can refer that for your examination also. That summary will be helpful to you. So that also you can refer. I think my connection was unstable. I had been logged out. So this is what all I wanted to share today with all of you. Any one of you want to share anything, or we can end the class? Sir, anything you want to share before ending the class?
No.
Okay. So all the best for your examination and start, keep your preparations with full rigor and full enthusiasm. So
Ma'am, do we have to take the other two class of statutory updates?
I think statutory update can we cover in one session, sir?
Yeah, we can cover that because majority we have already covered in the regular class.
Yes.
So if you mean that is what we need to inform them because otherwise the portion is complete.
So I think one class we can have for the practical questions, problem solving
Okay.
questions. And if that gets completed early, then you can start with the statutory update also in the next class. And one full session will be there for the statutory update after that.
So ma'am, should we allow them this week for their practice and we should take it in the next week on Monday, or we should complete it day after tomorrow as per our schedule?
I think we can go as per schedule, and students who are there in the Zoom link, they can also share their view, how they want to go about it. Geeta, Samyanathan.
Yes, ma'am. We can complete this next week itself, ma'am.
Next week or next session? Next session, that is
session.
Wednesday. Next week is Monday.
No. I mean the Wednesday we can take it.
Wednesday.
So this is what I felt from your.
Because I think they also want to quickly complete the
Yes,
syllabus,
correct.
and they want to
Yes, ma'am.
So we can.
Yeah, thank you so much for the feedback and advice.
Thank you.
And let us know that the RTP is also available now. It's a very good message for us, actually. Thank you so much, ma'am. Thank you so much, sir.
Thank you all. Thank you, ma'am.
Thank you, sir.
Thank you. Good support from ICAI, ma'am. So
ICAI is always there to support you.
Yes, ma'am. Really, I see our institute is taken a lot of facility to student from the BOS portal, like that revisionary class, that live class, and all the things are you are student friendly. In fact, really appreciated.
Definitely. And in fact, you should share this feedback with your friends also, so that they can also get benefited, because you know that this is something which we are doing only for the benefit of the students. Sole purpose is that the students can get benefited from these classes. So if you have your friends who also want to take the classes or who are having any issues in revising their syllabus, they can refer LVRC classes. They want to go through the entire syllabus, they can go for the LVC classes. So share the feedback with your friends also. That will help them in getting the benefit.
Okay, ma'am. Sure, ma'am.
yes, ma'am. Yes, ma'am.
So,
Okay. So closing off from my side
yes,
and
we can
from
end
our
it.
side.
Yes, sir.
Thank you so much, sir.
Thank
Good.
you, sir.
Thank you. Good night. Good night, ma'am.
Good night. Good night, everyone.
Yes, Ashok ji.